We have Pankaj Tibrewal now joining us. He's Senior Executive Vice President and Fund Manager, Equity at Kotak Mahindra Asset Management Company. Pankaj, good to have you with us here. Thank you very much for your time. It's been a feverish and a frenzied move in mid-caps and small caps. Portfolios are looking green, and I was talking to some PMS fund managers, monthly gains, at least the last two of 7, 10, early two-digit gains, monthly gains. So it's been fantastic. But what from here, Pankaj? How are things looking to you?
Good morning, Prashant. Yes, absolutely, you're correct. This calendar year to date, if you look at Nifty has returned about 3.5%, whereas mid and small caps have given about 10% odd returns. And stock specific, there are many stocks which have given 30 to 40% returns. So it's been a very strong move. And there's a reason to it that the earnings on the non-BFSI space, which largely comprises of mid and small caps. And if you look at the NSE 500 companies, 421 companies on the non-BFSI space have actually delivered better than expectation. If you look at the first 9 months, they were down about 9%, mainly led by oil and gas and metal and mining. But in the last quarter, due to the margin expansion, we saw that decline getting arrested to about 2%. And if you look, and if you remove metal and mining and oil and gas, actually there was a high single-digit earnings growth for the remaining non-BFSI pack. Also important to note that markets are smarter than all of us. And time and again, we have been talking about cash flows. And when we looked at the balance sheet and cash flows of corporate India, they have done an excellent job. 245 companies of the 421 non-BFSI companies have actually improved their working capital and cash flows in FY23. And now corporate India, the NSE 500 companies, have seen their ROE move to 14%, which was in 2019 at about 10%. And so has the valuation re-rated. And just to recap, now over the last 5 years, NSE 500 companies have delivered 18% CAGR on earnings, and so has markets responded. So I think over the medium to long term, markets are slave of earnings. Going into FY24, we believe that profitability on margins could surprise us positively. But on the top line growth, one should be a little careful because last 3 years, corporate India has benefited from inflation. Now, if you look at yesterday's number on WPI, second consecutive month of negative WPI numbers, which could weigh on the pricing and volume growth will be equal to top line growth. Whereas when I look at the street expectations, street is slightly higher on the top line growth. So this year will be more about improvement in margins and profitability and less on top line growth, which was just a reverse last year. So I think there are pockets of opportunity over the medium to long term. But in the very near term, we believe that markets are fairly valued. The undervaluation is very limited out there, and we need to be a little careful not to get carried away on momentum stocks.
Absolutely. Pankaj, many pockets are doing well. So just wanted to take that point forward in terms of individual stocks as well. Just want to pull some of them up. Fortis Health is now up almost 2.5%. KPIT Tech is actually bucking the trend we've seen in the mid-cap IT space, up about 2%. Something like a Marico is up 2%. KRBL is looking good. So a lot of individual stocks still doing well despite the market being flat. But Pankaj, talking about IT, right, there are multiple reports coming out which indicate that growth has slowed down across pockets, whether it's BFSI, and even, some of these short cycle deals are seeing either cancellations or deferrals. What do you do in the IT space now? Do you stay away entirely or do you look to buy the dip?
So the structural story on IT cannot be debated. I think we have a long runway for growth for the Indian IT services. But in the near term, absolutely, you're correct that what we are also picking up from our channel checks is that cancellations have picked up, especially on the BFSI space and discretionary space. And the next couple of quarters could be slightly painful from a revenue growth perspective, though margins could be still better than what we have seen in the last year because attrition levels are down. But don't forget that somehow the markets have factored into that. In the last 18 months, we have seen absolute price correction and valuation correction in IT companies. And from, overall contribution to overall profitability, IT sector moved to about 13-14% of the India Inc. corporate profitability pool. That is now down to about 9 to 10%. So I think if you take a 2-3 year view, I think next 2 quarters could provide opportunity to start increasing your IT exposure. And we are looking at such opportunity, and especially on the large cap IT names, we are seeing that valuations have meaningfully derated. And if earnings growth pick up maybe after 2-3 quarters, you could see opportunity like that.
Okay, got that. Pankaj, hi, good morning, Surabhi here. So we know that as a house, Kotak has been extremely bullish on the manufacturing revival story, right? And I believe, some of the themes like cement are a part of that. Perhaps, in the large cap space, you could look at capital goods. But I want to find out from you that when you're talking mid caps and small caps, then how do you play the manufacturing revival story, beyond the ABBs and Siemens and L&Ts of the world?
So Surabhi, structurally, we are positive on the entire revival of manufacturing, and this time it looks real. And when we analyze the previous cycles, we believe that the cycle lasts for anywhere between 5 to 8 years. In our view, we are in the second or the third year. And normally in the previous cycles, we have seen that margins double, ROEs triple, and valuations actually quadruple. Though on headline valuations, most of the stocks are looking expensive. BSE Industrial Index has seen a sharp run up, about 42% on the last 12 months. And most of the stocks are at near all-time high. So maybe in the short term, it may take a pause. But when you look at slightly medium to long term, BSE 500 companies for the first time have touched the 7 lakh crore mark. So government was doing the heavy lifting. Now private sector is joining the bandwagon. And the household, which is nothing but real estate, continues to do well. So all the 3 engines continue to fire. And we believe that large part of the manufacturing side lies in the mid and small cap space. Whether it be the short cycle plays like bearings, abrasives, whether it be the entire home improvement space to ride the real estate cycle, or whether it be the manufacturing, which is cement, chemicals, and some of the other pipe making companies, and so on and so forth. So I think it's a large, pool of companies and universe to select from. And we believe that over the next 3-5 years, manufacturing and the industrial capital goods cycle has still more legs. Just giving you a caveat that in the short term,
Sure.
there is a probability of a slight underperformance due to valuations.
Got that. Pankaj, since you mentioned chemicals, there's a question on my mind that of late, data has started getting a little patchy, and this is also one sector where there's a huge amount of global exposure. So you are, pretty exposed to global cyclicality of demand-supply cycles. So will that still be a go-to space for you, or are you increasingly getting cautious? How are you cutting up the chemical space?
So Surabhi, last 6 months back, we had a cautious view on this sector, saying that valuations have run ahead of fundamentals. And over the last 6 months, we have seen that sector consolidating. And in the near term, we believe softness will continue, led by decline in end product prices with the reopening of China. But however, if you take a slightly medium to long term, I think this is one sector where India has the right to win. And we have seen over the last 5-6 years how in the overall large pool, we have increased our market share from 1% to about 4%. So in the near term, we believe that there will be softness, there will be weakness, and that's what the stock prices are showing. They are consolidating. But if you take a 3-5 year view, these dips will be presenting itself as an opportunity to increase exposure whenever it warrants to. So from a medium-term perspective, we are quite positive on this space. And there are many companies which have shown that if you want a substitute to China, nonetheless, India is presenting the opportunity. So I think one needs to, kind of adjust the time horizon, but structurally quite positive on this theme. And this also forms a part of our manufacturing thought process.
The other space I wanted your thoughts on, because you started the discussion by saying that, the earnings recovery has largely been margin-led this time around, is the FMCG space, right? I mean, as we speak, names like Britannia, Nestle are all sitting at lifetime highs. And for Britannia, I was going through the earlier notes on what led to this margin improvement. I mean, it was almost a 700 basis points gross margin improvement this time, year on year, in Britannia's Q4 numbers. And now the stock is at 5,000 rupees. Is all the good news priced in, you think, Pankaj, for names like Britannia, Nestle, or do you think there is more to go given this margin outperformance?
Absolutely, we have seen a very sharp move in some of the FMCG names, and valuations are somewhere full. Though the margin expansion will continue, but I think markets have priced in already. And if you remember, Sonia, a few months back on your channel, we kind of talked about this gross margin expansion as one of the themes. And it's played out to a larger extent on FMCG. But I think it's still yet to play out in cement. And we believe that in cement, the way petcoke prices have started to correct from $200, the latest shipments we are hearing is about $100, $110. And that will make sure that in the next few quarters, the profitability will improve substantially. Is that factored into by the market? We believe not so much. And there, I think gross margins will play a big role. Also in some of the industrial and cap good names where raw material and energy intensity forms a large part of cost, we could see positive surprise there on the margin expansion as well. But on FMCG, just one more tailwind that, last 2-3 years, volume growth has been really subdued. We are going into the election year in the next 12 months. And our analysis suggests that 6 months before the election and 6 months after the election, the money gets spent at the lower bottom of the pyramid, and there where the consumption actually picks up. So we have seen some margin tailwind already play out, but the top line growth, which is volume expansion, has still not played out. And I think that would be a story for the second half of this year in FMCG.
Okay. Got it. All right. Top line growth, that could be the story for the second half of the year. So more tailwinds perhaps for this sector. Thanks a lot, Pankaj, for joining in.